Let's check the markets, which remain on edge. Stocks well off their lows. Oil is up. The communication services sector leading the S&P 500. Yes, a lot of red on the screen, not minimizing it. NASDAQ down more than 1%, Jim. But I will say this. When we started Worldwide Exchange this morning, when we got up, the Dow was down 500 in the futures market. NASDAQ futures down 2.5%, not minimizing these losses. But given what we saw early in the morning, buyers have come back into a bit. Your take on the action that we have seen so far today?
Yeah, I love you putting some perspective on this, Sully. Appreciate it, because perspective is what matters here. This is what a correction looks like, and we haven't had a correction in a long time. You know, we went a year and a half up until the end of last year with barely a 5% drawdown. So people have gotten unused to what a correction looks like. And we're down 10% peak to trough from the early January highs. That was only a month and a half ago. Okay, corrections generally last 2 to 3 months. If you look at the next 3 weeks, okay, in the next 3 weeks, you are highly likely to get some resolution on Russia and Ukraine. And I'm not saying which way it's going to go, whether Putin will go in or stay out, but you're likely to get some resolution there. Also, in 3.5 weeks, the Fed meets. And they're going to pull the Band-Aid off. They're going to rip the Band-Aid off. They're going to give us the first rate hike. Maybe it's 25, maybe it's 50 basis points. They'll give us some guidance. But here's the point. We'll be through the heart of the adjustment that the market is going through right now. Corrections last 2 to 3 months. I think this correction will be over by the first quarter. And Sully, when it's over, you've got corporate capex coming, you've got infrastructure, you've got jobs aplenty, and it looks like supply chains are easing. So there's a lot to be positive when you get through the next 3 weeks of chop.
Next 3 weeks of chop. You know, but we got to remember, Josh, we came into the Russia situation already in a weakening tape. I mean, the markets had started to rattle before Vladimir Putin rolled in. Your take?
I'm not a geopolitics guy, but it's not clear to me that we should interpret anything coming out of Eastern Europe or Russia's state-run media or our own talking heads on 24/7 cable channels as though anybody knows anything about what's going to happen there. Somebody could fire a shot accidentally, and it could completely change whatever our expectations are from 1 second to the next. So we should not spend any time on that. I agree with Jim. This is what a correction feels like. We have 25 million brand new investors who first started within the last 18 months. They've never seen this before. If you told me, I know statistically we're not in a bear market, but if you told me we were in a bear market, I probably wouldn't argue with you. If you think about the fact that 28% of stocks in the NASDAQ composite are down 60% or more, about a third of stocks are down 50% or more. Like when you look at a tape like that, yep, with this many names, you know, in that state, basically, it's a psychological bear market, whether the index reflects that or not. If you own individual names, it's a bear market for you. So that's not in and of itself a bad thing. And I do agree with Jim. Now we're through earnings. Earnings season was strong. The pre-announcements weren't great. There's a lot more negative guidance than we've had in recent quarters. But the countervailing force to those negative things are, now that we're out of earnings, the buybacks kick back in. That's one. Two, probably going to go a few weeks before anybody has anything negative to say. If they had something bad to say about the outlook, they would have dropped it in the last 4 weeks. And if there is some sort of resolution, even if it's war, by the way, the market actually prefers that to sitting here waiting to see what's going to happen. I hate saying that out loud. I'm just giving you the truth. So here's the last thing I want to say, Sully, and I'll let you go to the next person. One of the biggest mistakes investors make is thinking that they always have to know buy or sell. There's a third answer. Buffett talks about this game as being no called strikes. You don't have to do anything. So if you just put 5 long trades in a row in good companies and all 5 of them went against you within 24 hours, maybe stop. Maybe you don't do anything for a second, regroup, get your thoughts together. You don't have to have an answer every day, buy or sell. You could just sit tight. And I think if you've been doing that really since the second week of January, you're probably in better shape than the people who think they're going to trade their way out of this. You're not going to.